Most people want to build wealth, but they're standing in quicksand. They dream of compounding returns while paying 20% on a credit card. That's like trying to fill a bucket that has a hole in it. You'll pour for years and never see it full. The real question isn't how fast you can grow your money. It's how fast it's leaking out. Let's start with something very simple, the kind of arithmetic that doesn't lie, but that most people refuse to face. Imagine you're carrying a credit card balance with a 20% interest rate while you're excitedly investing in the stock market, hoping for an 8% return. What you're really doing, without realizing it, is trying to swim upstream in a river that's moving twice as fast against you. You can't compound wealth while compounding mistakes. The math simply won't allow it. The reason this point matters is because human beings have an astonishing ability to rationalize stupidity when it's dressed in optimism. We love the idea of growth. We love the excitement of making our money work for us. What we often ignore is that debt is already working against us, relentlessly, silently, and with mathematical precision. Paying off high-interest debt isn't a glamorous move. It doesn't sound clever, and it doesn't make for great dinner conversation. But in the real world of numbers and compounding, it's one of the smartest and most reliable financial decisions you can make. Charlie Munger once said, "It's not supposed to be easy. Anyone who finds it easy is stupid." And that's especially true with money. The easy route, keeping the debt and hoping your investments will outrun it, is emotional thinking disguised as financial sophistication. But Munger built his entire philosophy on the opposite principle, invert. Avoid stupidity before you chase brilliance. If you just avoid doing dumb things, you'll automatically do smart ones by default. When you look at debt through that lens, the logic becomes painfully clear. If you owe money at 15%, paying it off is a guaranteed 15% return. Guaranteed. Show me another investment that gives you that kind of certainty with zero risk, and I'll show you a fantasy. You can't compound wealth while paying the kind of rates that make banks rich and keep you stuck. Paying off debt is not a step backward. It's the only reliable forward step available to someone who's still leaking capital every month. But beyond the numbers, there's a psychological truth that's even more powerful. Carrying debt subtly changes how you think. It creates a background hum of anxiety that makes rational decision-making harder. You might not even notice it. It's just there, influencing every choice you make. When you owe money, your time isn't fully yours. Every decision you make carries a shadow. The awareness that some of what you earn belongs to someone else. That awareness narrows your field of vision. You stop thinking long-term because your mind is occupied with short-term survival. This is why people in debt often fall for quick fixes, day trading, crypto hype, get-rich-quick schemes. It's not because they're greedy. It's because they're desperate for a sense of control. They want to believe there's a fast way out. But as Munger would remind you, reality doesn't care about your feelings. The laws of compounding don't bend for impatience. The intelligent way out is the boring way out, steady, consistent repayment, and the refusal to play financial games until your base is solid. There's also an ethical dimension to it. Debt is, at its core, a promise. You told someone or some institution that you would return what you borrowed with interest. And if you make investments while owing that money, you're essentially using someone else's capital for personal speculation. Munger, being a man of deep moral pragmatism, would call that playing with other people's chips. He never believed in shortcuts, not because they don't work occasionally, but because they rot your character over time. Wealth without integrity isn't real wealth. So when you pay off your debt, you're not just balancing numbers, you're restoring integrity to your financial life. You're sending a message to yourself that you can be trusted with capital, that your word means something. And once you prove that, opportunities start to come naturally. People, banks, and even markets trust discipline. They reward it quietly but powerfully. The smartest financial minds in history share one common trait. They think in probabilities, not possibilities. And the probability that your 8% return will beat your 20% debt after taxes and volatility is almost zero. But the probability that paying off that debt will leave you richer, freer, and more mentally clear, that's nearly 100%. So before you think about the next investment trend or the next big opportunity, remember this simple truth. Wealth doesn't begin with making money. It begins with keeping it. And the first dollar you truly keep is the one you no longer owe. Interest rates tell stories if you know how to listen. They're not just numbers printed on loan agreements. They're a mirror reflecting how the world perceives your reliability, your habits, your discipline. When a lender charges you 18% interest, they're not trying to be cruel. They were simply expressing what your past behavior says about your likelihood to pay them back. The market isn't emotional, it's brutally rational. It prices your reputation into every percentage point. This is why your relationship with interest rates is also your relationship with reality. If you're buried under high interest debt, it's the financial world's way of telling you that something about your current system isn't working. And that message deserves your full attention. Because until you fix the behaviors that created that situation, investing is like trying to plant flowers on rocky soil. It looks hopeful, but nothing truly grows. Charlie Munger has always emphasized that the world is a report card on your behavior. If you make intelligent decisions consistently, you eventually earn good outcomes. If you take shortcuts or rationalize poor ones, the market will hand you a bill with compound interest. When interest rates are high, it's not punishment, it's feedback. It's telling you to earn trust before you demand reward. Now, consider what happens psychologically when you ignore that feedback. You start living in fantasy instead of fact. You tell yourself stories like, I'll invest my way out of this debt, or my future income will cover it later. That's not optimism. That's denial dressed up as strategy. Munger often said, the human mind is a lot like the human egg. Once one foolish idea gets inside, no other idea can enter. High interest rates should be a wake-up call, not an excuse to double down on risk. When you look at your financial life honestly, you'll see that interest rates teach discipline if you let them. Low rates reward responsibility. High rates punish neglect. The person who manages their finances prudently gets to borrow cheaply. The person who doesn't pays dearly. There's deep justice in that system. It's meritocracy in mathematical form. It's not about luck or opportunity. It's about trustworthiness, and trust compounds like capital. Think of interest rates as signals rather than obstacles. When they're high, it's the world saying, slow down. You're borrowing too much future. When they're low, it's saying, you've proven stability. You can handle more leverage. But the wise person doesn't rush to borrow just because they can. They understand that low rates are a privilege, not a green light. Munger's worldview has always been about restraint, knowing when to act and when not to. He admired patience more than brilliance. And in the world of money, patience is what keeps you solvent when others get greedy. What's often missed in these discussions is that managing interest rates isn't just a financial exercise. It's a philosophical one. Paying down a 15% debt is also paying down 15% of your impulsiveness, 15% of your self-deception, 15% of your dependency on others' capital. It's not merely reducing liabilities, it's refining character. Munger believes that financial integrity mirrors moral integrity. If you can't control your desires, you'll always end up paying someone else for the privilege of chasing them. The irony is that once you demonstrate discipline, once you pay off what you owe and live below your means, the world starts to trust you. Banks offer you lower rates. Employers see you as dependable. Even the market seems to reward your steadiness. In other words, the price of money falls as the quality of your behavior rises. That's compounding in its purest psychological form. So before you ask, should I invest or pay off debt, ask a simpler question. What are my interest rates saying about me? Because those numbers are a reflection of your habits, your patience, and your relationship with delayed gratification. Ignore them, and you'll repeat the same mistakes under fancier circumstances. Listen to them, and you'll become the kind of person who doesn't need to ask that question again, because your financial life will already be in harmony with reality. The market always tells the truth, even when it's uncomfortable. And when it speaks through interest rates, it's giving you the most valuable information of all, a mirror of who you've been and a map of who you could become. Everyone loves the idea of compounding. It's one of those magical concepts that turns ordinary people into millionaires and small decisions into great fortunes. But here's what most never grasp. Compounding doesn't care whether it's working for you or against you. It's completely indifferent. It will magnify whatever side of the equation you stand on. If you're disciplined, it rewards you. If you're careless, it punishes you. Compounding is the closest thing in finance to moral law. Now, most people hear about compounding in the context of investing, the way small, consistent returns over time lead to exponential growth. But debt compounds too, and it compounds faster because the interest on debt doesn't wait for your permission. It doesn't ask if you had a bad month or if the market turned against you. It grows steadily, mechanically, like rust on metal. If you owe money at 20% interest, every day you delay payment, that debt multiplies. It's the same beautiful mathematics, just turned against you. This is why Charlie Munger always said the first rule of compounding is never interrupted unnecessarily. What he meant was simple. Once you've built something that compounds in your favor, protect it. But the inverse is also true. If something is compounding against you, stop it immediately. Because every day you let it run, it grows in size and power. And before long, you're not managing money anymore, you're managing consequences. Think of two people. One has $10,000 in investments, earning 8% a year. The other has $10,000 in debt, growing at 18% a year. Both are experiencing compounding, but in opposite directions. After 10 years, the investor's money roughly doubles, turning into about $21,000. The borrower's debt, however, more than quadruples, ballooning into nearly $52,000. That's the cruel genius of compounding. It amplifies both virtue and vice. It rewards patience and punishes procrastination equally well. But the most dangerous part isn't even the math, it's the psychology. When people see their investments compound, they feel encouraged. It builds optimism, confidence, and a sense of control. But when debt compounds, it does the opposite. It breeds anxiety, guilt, and paralysis. You stop thinking in terms of growth and start thinking in terms of survival. And once your psychology shifts from offensive to defensive, your ability to create wealth evaporates. You can't invest rationally when you're emotionally cornered. Munger often warned against what he called self-inflicted problems. Debt is one of the clearest examples. He believed that most people sabotage themselves not because they lack intelligence, but because they underestimate how relentless mathematics can be. The human mind isn't built to intuit exponential growth. It's built to think linearly. You see small increases and think that's manageable. But the doubling effect sneaks up on you. First it's small, then it's urgent, and suddenly it's irreversible. The irony is that compounding, when used wisely, is the closest thing we have to financial freedom. But when you ignore it, it becomes the mechanism of your servitude. The same force that makes millionaires out of disciplined savers makes slaves out of careless spenders. And it doesn't care which role you choose, it just keeps calculating. This is why the intelligent person doesn't just invest in markets, they invest in avoiding negative compounding. They pay off high interest debt before chasing returns. They understand that compounding wealth only matters when you're not simultaneously compounding losses. You can't have one foot on the gas and the other on the brake and expect to move forward. Philosophically, compounding represents the principle of alignment between time and behavior. If your actions align with the passage of time, you grow richer. If they don't, you grow poorer. It's not personal, it's structural. Compounding is simply time's way of showing you the long-term consequences of your short-term choices. So when you think about investing versus paying off debt, remember this: the most powerful financial force in the universe doesn't play favorites. It doesn't reward effort, it rewards alignment. The moment you align your money with the direction of time, when compounding starts to work for you, not against you. You stop fighting the current and start being carried by it. And that's when real wealth begins. Debt doesn't just drain your wallet, it occupies your mind. It changes how you think, how you sleep, and even how you make decisions. You might not feel it every hour, but it's there like background noise, quiet, persistent, shaping your choices without your permission. The problem isn't only that debt costs money, it's that it taxes your clarity. And clarity, as Charlie Munger would tell you, is one of the most valuable assets in life. When you're carrying debt, you're living with a silent pressure that never fully goes away. Every bill, every due date, every interest charge becomes a reminder that part of your future is already spoken for. You can't look far ahead because your energy is tied up in what's behind you. It narrows your time horizon. And when your time horizon shortens, your decisions follow suit. You stop thinking about 5 years from now and start thinking about 5 days from now. That's how debt turns intelligent people into reactive ones. This is why Munger always stressed emotional stability as a cornerstone of sound decision-making. He understood that money problems are rarely just financial. They're psychological traps. Debt triggers stress, and stress creates tunnel vision. You start making choices to relieve pressure, not to create prosperity. You gamble with investments you don't understand. You chase quick wins, and you convince yourself it's strategy when really it's desperation in disguise. The truth is, no one makes good long-term decisions from a short-term mindset. And nothing shortens your mindset like owing people money. It's hard to be rational when you're anxious. It's hard to think clearly when you're trying to escape discomfort. People in debt often start taking financial risks they would have laughed at when they were calm because anxiety rewires your logic. You start thinking in emotional terms. What can get me out fast instead of rational ones? What will work over time? That's how you lose twice, first to interest and then to impatience. Munger's approach to life was built on one principle: remove the sources of stupidity before chasing brilliance. If you can eliminate the things that distort your judgment, you've already outperformed most people. Debt is one of those distortions. It doesn't just distort your balance sheet, it distorts your perception. When you're financially strained, you start comparing yourself to others, resenting their stability, envying their freedom. And as Munger pointed out, it's not greed that drives the world, but envy. The moment envy takes root, reason leaves the room. Freedom then is not just about having money, it's about having mental space. When you're not weighed down by debt, your decisions slow down. You start thinking in decades, not days. You stop chasing dopamine and start pursuing compounding. The irony is that once you no longer need fast results, you start getting them because calmness makes you competent. You invest not to escape something, but to build something. You're no longer reacting, you're architecting. There's also something deeply philosophical about living debt-free. It's not only a financial state, it's a psychological one. You're no longer bargaining with your future. You're not renting peace. You own it. The absence of debt gives you an internal stillness that's rare in a noisy world. It allows you to say no to poor deals, to toxic environments, to anything that compromises your integrity. When you owe nothing, you can think clearly. When you can think clearly, you can act rationally. And when you act rationally over time, success becomes nearly imitable. That's the part most people miss. Debt isn't just an obstacle to wealth, it's an obstacle to wisdom. Because wisdom requires stillness. It requires a mind that's not under siege. The person drowning in payments doesn't have the bandwidth to think deeply, to plan carefully, or to delay gratification. And without those qualities, compounding, the very essence of wealth, can't work its magic. So if you want to think better, live better, and invest better, start by lightening the mental load, pay off what you owe. Silence that background noise, because once your mind is free, your judgment improves, your patience strengthens, and your entire financial life begins to align with reality. Clarity is wealth, and freedom from debt is where clarity begins. Not all debt is evil. That's something most people misunderstand. Debt, like fire, is neither good nor bad. It's simply powerful. In the right hands, it cooks your dinner. In the wrong hands, it burns your house down. The goal isn't to avoid debt entirely, it's to understand when it serves you and when it owns you. Charlie Munger understood that distinction better than almost anyone. He wasn't anti-debt, he was anti-foolishness. When your debt carries a low interest rate and you've built strong habits of saving and discipline, you can start to view it as a financial tool rather than a financial chain. A student loan at 3% or a mortgage at 4% doesn't necessarily need to be extinguished immediately if you have the temperament and ability to invest wisely. The key word there is temperament, because what separates a wise investor from a reckless one isn't math, it's psychology. The numbers might tell you that investing offers a higher return than paying down low-interest debt, and they might be right, but that's not the whole story. Investing requires emotional stability, patience, and a tolerance for volatility. If you can't watch your portfolio drop 20% without losing sleep, you have no business holding debt at the same time. Munger used to say that the ability to handle discomfort is one of the most underappreciated advantages in life. The market tests your emotional structure long before it rewards your intelligence. So the real question isn't whether you can invest while holding debt, it's whether you deserve to. Have you earned that right through discipline? Do you actually understand what you're doing? Or are you just hoping for a better outcome than the math suggests? Munger's whole philosophy rested on the principle that the best decisions come from clear thinking, not wishful thinking. If your debt makes you anxious, or if you're counting on market returns to save you, then you're not acting rationally. You're gambling with borrowed peace of mind. It's easy to rationalize leverage when times are good. Everyone looks brilliant in a bull market, but debt is a test that comes due when the tide goes out. Munger often quoted Buffett's line, "Only when the tide goes out do you discover who's been swimming naked." The problem with using debt to invest is that you never truly know when the tide will turn. And when it does, the leveraged investor doesn't get a second chance. Debt amplifies not only your gains, but your mistakes. It magnifies human error, and the world is full of it. However, when used conservatively and with full awareness, debt can accelerate intelligent growth. A fixed-rate mortgage that allows you to buy a productive asset, or a small business loan that funds something you understand deeply, that's a rational use of debt. The key is alignment. The moment your debt serves a purpose that produces more than it costs, and you can weather short-term storms without losing sleep, you're in control. But that control is fragile. The line between strategic debt and reckless speculation is thinner than most people realize. That's why Munger's approach was never purely mathematical. It was moral, psychological, and deeply philosophical. He believed you should never let money situations force you to behave differently from the kind of person you admire. If your financial structure makes you anxious, if it puts you in a position where you have to cut corners, then it's not intelligent, even if it's profitable on paper. A calm mind is more valuable than a leveraged portfolio. So when people ask, should I invest or pay off debt? The answer depends less on the numbers and more on your nature. If you have the emotional balance to handle volatility and the patience to think long-term, low-interest debt can be managed while you invest. But if your debt feels like a weight, or if you're chasing returns out of fear rather than conviction, it's time to pay it off and earn your peace first. Because at the end of the day, true wealth isn't about maximizing returns, it's about maximizing options. And the person who's free from psychological debt, not just financial debt, always has the better options. At some point, the conversation about money has to rise above numbers and return to what this is really all about: freedom. Not the flashy, performative kind that comes from possessions, but the quieter kind that comes from control over your own life. Debt limits that control. It dictates your choices, your time, and even your emotions. When you owe money, part of your future is already sold. When you invest, you're buying your future back. And that difference between being owned and owning is where the true meaning of wealth lives. Charlie Munger always viewed money as a tool for independence, not indulgence. He didn't care much for status symbols. He cared about optionality, the freedom to say no, freedom to walk away from foolish deals, dishonest people, or environments that compromise your values. That's what financial strength buys you. It's not luxury, it's leverage over your own destiny. But you can't get there if your life is structured around obligations. You can't be independent when your next move depends on your next paycheck. Paying off debt is the quietest path to that freedom. It's not glamorous. No one congratulates you for it. But what it gives you in return is profound peace of mind. When you wake up without debt, your life feels lighter. The noise fades. You stop calculating survival and start planning growth. Your mind becomes available again for thinking, for creating, for compounding. That's something most people underestimate. The link between mental space and financial power. A clear mind makes sharper decisions, and sharp decisions over time build wealth faster than any interest rate ever could. But freedom isn't just financial, it's psychological. When you're not weighed down by debt, you think longer term. You stop reacting to every dip in the market, every headline, every minor inconvenience. You start to see money for what it is, a servant, not a master. People in debt often confuse urgency with importance. Every financial move feels critical. Every setback feels personal. But once you're debt-free, that emotional volatility disappears. You can finally afford to be rational. And in the long game of wealth, rationality compounds faster than luck. Munger's philosophy was built on this kind of inner calm. He admired people who could sit quietly while others panicked, because that's when compounding does its best work. And you can't develop that temperament if you're under pressure to meet payments or cover obligations. You need stillness to think clearly. You need patience to let your ideas and investments mature. That's the real dividend of a debt-free life, not just interest saved, but wisdom gained. It's also about character. Munger often said, the best way to get what you want is to deserve what you want. Paying off debt is an act of deserving. It's proof of discipline, reliability, and integrity, all qualities that compound far beyond your bank account. The same habits that eliminate debt are the ones that build wealth, restraint, consistency, and rational thinking. You don't just become richer, you become someone who attracts opportunities because you can be trusted to handle them. And here's the paradox. Once you've earned freedom through discipline, money starts to matter less. You stop chasing it for validation and start using it for design to build a life that aligns with your values. Financial freedom, in its truest sense, is the ability to live without distortion, to make decisions unclouded by fear or dependency, to say no when others must say yes. That's the quiet power of a debt-free life. In the end, it's not about how much you earn or even how much you invest. It's about how much freedom you create for yourself, because freedom compounds, just like money. Each smart, rational decision adds another layer to your independence. And when you reach that point where your choices are your own, your time is your own, and your mind is free, that's when wealth stops being a number and becomes a state of being. True wealth isn't measured in dollars. It's measured in how little of your future you've sold. You don't need to choose between paying off debt or investing. You need to choose between short-term comfort and long-term clarity. The moment you prioritize clarity, you'll make the right choice automatically, because the math, psychology, and philosophy will all point the same way. Eliminate the dumb, and the smart will take care of itself.